I've been publishing the Investment Trust newsletter since 1996, and every month we bring our subscribers a mix of our own research and that from the leading brokers in the sector. After following the sector closely for this length of time, it's obvious to me that the sector can offer great value to investors, but also that some trusts are very much better than others. The majority of investment trusts, excluding those devoted to the UK, are designed to invest in specific sectors, whether these be geographic or by industry type. Many invest, for example, across Europe or Asia or Latin America. If these are the shotguns of the industry, though, there are sniper rifles too. These are the trusts focused on just one single country. These are the single country trusts. Well, there's been a lot of negative reporting recently on Anthony Bolton's experiences to date with the Fidelity China Special Situations Trust, which has lost value since launch. It's down from £1 to 74 pence as at 14th of December 2011. I think some of the criticism of the trust is probably unwarranted, and there's definitely an element of schadenfreude. Even so, we have been negative on the trust since its launch, partly because we were not convinced of the case for China against the rest of Asia, and we had our reservations as well about the charges on the trust. More recently, though, I think we've felt a growing sense of unease about single country trusts more generally. For the extra risk that you're taking, the geographically specific risk, these trusts really ought to be delivering superior returns over time, but I doubt whether this has really been the case. Our sense is that even with the countries with terrific GDP growth data and none of the debt problems of the West, these have failed to translate these splendid economic figures into real good returns for stock market investors. Of course, yes. I mean, in Latin America, JP Morgan Brazil has failed to outperform the regional trusts over the last year. In Europe, JP Morgan Russian Securities has underperformed over both 1 year and 5 years against the rest of the European sector. And in Asia, we've found that with one notable exception, again the relative performance of the single country trust has been poor. Here is a bar chart showing the net asset value performance of Asian trusts over the last year. You'll see that over the year, obviously a down year, only Aberdeen New Thai stands out above most of the regional Asian trusts, with the other single country funds firmly at the bottom of the pile, anchored by Fidelity China Special Situations. China and India do not seem to have been the best places to have had your money over the last year, but perhaps that's because these are high beta markets likely to underachieve during bear periods, but to more than make up the lost ground during better times. Well, probably not. Over 5 years, a positive overall period for stock markets, these single country funds fare little better, with Aberdeen New Thai again being the standout exception, but with JP Morgan Indian bringing up the rear. And which trust has by far the widest discount in the entire Asian sector? Yes, Aberdeen New Thai, on a discount of 16.8%. It might be time for a re-evaluation of single country trusts and what they can achieve. It's good that they exist to provide an extension of choice and to enable investors with specialist knowledge to back particular ideas. But I think for more general investment purposes, the general regional trusts may well offer better prospects. It may be time as well for some of the discounts to shift. Notwithstanding the manager's still strong reputation, it makes no sense to me that Fidelity China Special Situations should trade on a discount of just 2.1% when Aberdeen New Thai stands on a 16.8% discount.